All right, we've had a slew of economic data today, much of it painting a picture of a growing economy. The latest PMI data showing U.S. manufacturing activity expanded by the most in almost 2 years. Home sales rising in February by more than estimated, at the fastest pace in a year. And initial jobless claims fell last week, suggesting that job growth remained strong in March. All of this coming against a backdrop of the Fed saying 3 cuts are still on the table. And the result, of course, has been some serious market optimism here. Let's talk more about what's going on with the expansion and what we're seeing in the economic data. We got the founder and president of MacroPolicy Perspectives, Julia Coronado, joining us right now. Hi, Julia.
Hi, how are you?
I'm doing great, thank you. Out of all of that economic data today, one thing that stood out to me is that within the S&P PMI report, we saw the measure of prices charged by manufacturers climbing to its highest in more than a year. And of course, I'm watching everything inflation related very closely. What did you make of that and also the Fed's comments yesterday specifically on inflation?
So with the manufacturing report, the prices index, sub-index, tends to track commodity prices and energy prices in particular fairly closely. So we know that energy prices, that oil prices have gone up to the upper end of the range they've been in recently. That's not a terribly big surprise. It doesn't necessarily contain a broader signal content for prices in the economy. The manufacturing sector in the U.S. is relatively small, and really the services sector is the driver. So I'm not alarmed by it. I don't read a broader signal in it. I do agree with your characterization that the full suite of data that we've got suggests that the economy remains on track. We're tracking a little south of 2% on our GDP tracking, partly because the consumer spending side of things softened a bit in Q1. But that's probably, just part of the usual ebbs and flows. It was probably a little bit overstated in Q4, a little bit soft in Q1. On average, I think consumers have jobs, they're spending, and the economy remains on track.
Julie, it's interesting just to see how investors are reacting. Yesterday, big up day. We're higher again today. Do you think, Julie, we might want to take kind of a deep breath here, though? I mean, aren't there's some risk that looking ahead, we get more of those firmer than expected inflation prints?
That's always possible. One of the key changes in the landscape over the last year that has facilitated inflation taking a pretty big step down is that consumers are price sensitive again. So we have to be careful about translating every change in input costs for producers into costs for consumers. Before the pandemic, we did not see that. Firms did not have a ton of pricing power. Then during the pandemic, price sensitivity melted away. Consumers were awash in stimulus, and they could only spend on a few things. So firms enjoyed some pricing power. That has melted away again. We hear that in earnings report after earnings report. It has helped restore lower inflation. It means that, firms are looking more towards efficiency gains and cost cutting to maintain or enhance margins. So I don't think we're back in that environment where every wiggle of input costs gets priced through to the consumer and to broader inflation. I am not particularly worried about that. And I don't think it sounds like the Fed isn't quite as worried about that as they were last year when they were getting all this good news on inflation. They were deeply skeptical. It continued. You had a little bit of a setback at the beginning of the year, but less than last year. So annual rates of inflation keep moving down. It's interesting times because there's a wide range of views in the market amongst our clients. There's just tremendous range of views between people that are sanguine on inflation like ourselves and those who do think that there's another upsurge around the corner and that the Fed's about. People think the Fed's going to make a mistake in one direction or another. And we actually think that they're balancing the risks reasonably well.
It does feel like people who don't have confidence in the Fed never have confidence in the Fed, no matter which way.
That is true. That is true. The Fed is always the favorite lightning rod for the market. So.
Yes, I'm sure you and I've heard from some of those folks over the years. But Julia, when we talk about the persistence of so-called super core inflation, that which the Fed has been watching closely, How do you think that is going to play out this year in maybe finally starting to moderate a little bit more? Where's the alleviation of the pressure going to come from on that front?
That's a great question. So we have a very specific view. We've seen goods inflation go back to pre-pandemic rates of deflation. We actually think we're going to get a little bit more deflation on the goods side this year, particularly from cars. New car prices are finally cracking with improvements in inventory and chip availability, and again, consumers back in the driver's seat, pun intended, and driving prices lower. So new and used cars are poised to fall this year, fall outright. The housing inflation is we think going to be the next one to take a step down. We have all the leading indicators, as Powell said yesterday. Timing uncertain, but direction seems clear. Supercore, we think, will be the last to give way. There still is some stickiness in things like car insurance, financial services. So we do think that is going to gradually moderate over time, but we're not relying on that to lead the way. We think that's going to be the last thing to step down.
Julia, thanks so much for joining us today. We appreciate it.
Pleasure.